Hi, I'm Taylor, and I want to talk about how to use the standard financial model to model an e-commerce business. Now, the model is pre-built to handle a wide variety of things you would want to build an e-commerce model, so it's a great starting point to building out for an e-commerce business. So I'm going to start and get started by kind of going through the general flow here. Now, the model itself is modular, meaning that the core revenue calculations is separate from the rest of the expenses and financial statements and reports. So if you want to add on additional components or have a mixture of a SaaS and e-commerce or have a direct and a wholesale strategy, whatever that might be, it's easy to add on additional components to model any of the other sides of the revenue stream. So I'm going to start with like a typical direct-to-consumer e-commerce approach. It's very easy to add on any other sort of revenue streams by building it however you want to and linking it into the forecast sheet. And we'll probably cover it in the end. So on the Get Started sheet, the general flow here goes acquisition to conversion to retention or repeat, and then revenues. So the first thing I do is we set up the basic parameters for the terms. Now the reason why this is important is because we want the terms to make sense for what you're building. Typically for your D2C, we're going to do something like, say sessions or traffic or website or something like that. And then usually this will be something like customers or orders, one of the two. And I want to use this dropdown to select an e-commerce business. The reason why I do that is because changing e-commerce will change a number of the terminologies and some of the calculations that are used to reflect how to best structure it for an e-commerce business. So then now that I've set this for sessions, my growth metric or my top of the funnel is going to be defined as sessions. So sessions are going to start with, say, a number of sessions in a month. And it's going to start on a certain date. It doesn't have to be the first date of the model. And then they're going to grow. The first assumption says maybe it's going to grow by 15% per month. And it just stays constant at 15% per month. But maybe I'm going to start at 15% and it's going to go down by 5% after that. So it starts at 15% and then goes 14%, 13.5%, something like continues to decrease over time, which is normal to grow and then grow at a decreasing rate over time. Now, there's an option here for seasonality. Now, the way this actually gets used is you can select to use it or not, and there's a seasonality section at the bottom. And the way this works is you can say for certain parts of the year, you can do maybe a plus percentage growth where it's higher, and maybe during some other periods it's negative. Now you kind of want it to be, you kind of equal out to 0 at the end there, with the sum of all the pluses and minuses. But what this will do is this will create a seasonal impact on the core metrics that we're using directly on the revenue sheet. This seasonality impact can be used for both the growth rates as well as the conversion rate, and as well as the average revenue per customer per order. Now, this is another important assumption here for the CPA per paid session. Now, this is going to be cost per acquisition per session. So this is a measure of what it costs based on the term I'm using. It's the cost used to land traffic, effectively, or drive a session. Now, the way the model works is I'm forecasting out growth, and I assume a CPA, and then I'll calculate out the marketing expenses that results from that growth. Another way to do this is to model out the cost of revenue spend and assume a CPA or a CAC, and model out the number of sessions or customers you get from that. Mathematically, they're the same. It's just a question of which one makes most sense to you in terms of how you have a personal preference in laying out your numbers. The most important thing to me is to make sure that we're accurately accounting for the cost of growth. It's a very common problem in models in general. So the most important thing is make sure we account for that cost. So if you can use this methodology or use a different one if you prefer, make sure you account for the cost of growth. Now, the conversion ratio basically is going to say the conversion ratio from sessions to customers. Let's just choose a more DTC friendly rate, something like 2.5% or something. It has a lag, not common for D2C or e-commerce, but you could say, hey, if there's a session happens in 1 month and it takes them 2 months to make a purchase, you could assume a lag there. But most times we're just going to assume that happens within the current month period. Now, this repeat rate's important. So So the model is going to do its forecast of customers, and if I'm assuming a repeat rate, it's then going to forecast out repeat orders from that customer. So for every month of new customers I get, they'll place an order or they have some average revenue from them. Then they'll continue to repeat over time. If I was just modeling orders, I'd probably just not use the repeat rate. I would just say, well, each order is independent of like a customer relationship. If I was modeling, say, like an Amazon business, for example. But if I do have this idea of customers and getting them to repeat purchase over time, then I will use this repeat assumption to drive that. And the way this sets up is basically 25%. What this assumption says is 25% of customers will do a repeat order every 3 months. Now, it's actually going to decrease over time, and I'll show you how to set the repeat rate assumption discretely for your assumptions on the revenue sheet. But by default, it basically creates a declining repeat rate over time, but people will be repurchasing every 3 months. But I can change this to be every month or every 2 months or every 12 months or whatever that may be. This cost per repeat, what this says to account for is say, hey, maybe I've spent the money on acquiring the customer from the beginning. Perhaps there is some marketing expenses that's necessary to continue to drive and make repeat purchases. That's where this assumption would play in. If I was using orders and not using any repeats in that scenario, I wouldn't use it. But this is valuable to make sure that I'm accounting for the full cost of driving growth and driving revenues. Now, this average revenue per customer is going to reflect average revenue per month per order or per customer. Now, this will define is the average revenue. I can define, say, if it's like $19 per order, and this defines like how many repeat transactions like every month. This is really just left as like one. So I would change this if it was a scenario where, say, you're driving an example would be if you were purchasing ahead of time for like 3 months supply of something. You could say it's $19, but it's covering, maybe by 3 months of supply be one way to do it. But in most scenarios, you would just assume the average revenue that reflects the total. So you're probably just always going to assume one in this case. And the rest of the assumptions reflect more for like marketplace style businesses. Not going to be necessary. So all of this results in calculations in the revenue sheet. Now, a couple important things here. One, we have this calculation here called for growth. Now, this first line is the growth or the number of sessions per period that's calculated from the assumptions that get started. But there's a couple of additional ways to change that. The seasonality impact, if I'm using that, will put pluses and minuses on top of the actual number of sessions that are calculated based upon the seasonality impact. But I also have this manual input line. The manual input line is an additional impact or additional growth that I can manually shape each individual month to account for one-off spikes or partnerships or big announcements or whatever I want to do. You can also choose to just zero out the growth assumptions and get started. You could just put zeros in for the sessions and the growth. And I could manually type in the number of sessions that I want or create my own logic for sessions going across. So it allows an additional level of flexibility to account for one-off as well as your completely own calculations around it. The cost per acquisition per session, percentage acquired via paid, and then acquisition costs are calculated throughout there. Those actual costs feed into the forecast sheet and then flow through the rest of the model. The conversion rate is calculated there, and the same thing, you have the ability to use seasonality impact as well as a manual input as well. Now, what this does is it calculates out new customers per period, which feeds into new customers per period. Now, this is the important part. I have this calculation of new customers that happen each period, and then directly below it, I'm calculating out repeat customers per period. And the repeat customers uses this retention rate per period curve, which is generated from the assumptions we made on Get Started. Now, if you want to create your own methodology for that, you still can. Right? There are some pre-built methods here using the drivers, which I cover under the documentation for drivers. But this is also an input. So if you have a very specific customer repeat curve that you want to model in there, you can also just manually input it as well. And that will apply to all customers because the way this works is this is a cohort-based model. So under here, for example, I can go here and open up the model to show all of what happens to customers per period for each new cohort of customers that are at each period. I can see their repeat purchases over time. So the total purchases, basically all the new plus all the repeats. There's some additional assumptions around here on the cost of retention costs, but the core part of the rest of this is around revenues. Now, by default, the model just says, hey, if I input $19, it says every time there's a purchase, $19. You don't have to assume that, though. Same way we looked at the retention curve, you can also change that. If you want to build it out where you assume it's $19 for the first one, and maybe it's $25, and maybe it's $30, some increases in revenue over time as they make additional purchases, or maybe a decrease. Maybe if there's a substantial difference to an average order value between first order, second order, third order, whatever, you can model that in here by adjusting this curve, and that'll then get applied to the actual purchase they make each period. So it applies across the cohorts. So you can model any degree of variability or difference into that. And the revenue gets calculated from that as well. All the calculations from there feed into the forecast sheet, which then flow through the rest of the model to create all the financial statements and summaries and charts and everything else. So a couple things you may ask is, okay, well, what if I need to change that structure, or common things to change? One would be if there's a different conversion funnel, right? So if you don't want to assume it's just a step from sessions to customers, but there's something in between, like free trial or free account or some other intermediate step, you can do that. On the revenue sheet, you can either build in another conversion step. So this is one, like a conversion step, it calculates a conversion rate in new customers. I could calculate another conversion step. I could make the assumptions directly on here or put them also to get started, but just insert rows, duplicate this section, and create one additional conversion step. Because what happens is this new customers line, this is just drawing from the number of sessions from the previous one. So to create another line, I would duplicate the session, put it in there, and then just change this calc so it pulls from the new whatever from the previous line. So it's very easy to add in additional steps. Another common thing would be, well, what if I want to do multiple channels? The default growth section is effectively all channels, paid and organic. You could choose to split this out into different paid channels. If you want to model out, say, Facebook or SEO or other channels, to model each one specifically with different growth rates. Very easy to do. Same thing as the idea of conversion. Take this growth section and then duplicate it. And I can make specific growth assumptions and specific cost assumptions for each channel. Then all I do is sum them all up, right? So this line, what the model here in the conversion rate is using this manual input line. I can either create multiple channels and sum them up into here and then just assume one conversion rate, or I could take this set of calcs, which basically covers top line, top of the funnel growth, and then conversions from that channel. I could duplicate this for each channel I want to model and calculate total conversions. And as long as I feed the total conversions here into new, this line, then it'll flow through the rest of the revenue calculations, the retention calculations, everything else. So it's very easy to do. You might ask, how do I add in multiple SKUs? So the assumption here is around average order value. So it's just going to say average order value of $19 with their repeat. So we can get more detail around that. One way to do this is to create like a little table. Maybe you have a different sheet, or you maybe change it directly on here. Not uncommon to create like a different sheet, especially if you have like a detailed SKU list. There's probably a level of detail that you like already have that we can kind of utilize. So you could say SKU 1, SKU 2, SKU 3, and you would say what the prices are. So 19, it's 15, maybe it's 25. And then I want to do the number per order. So maybe this is 1, maybe this is like maybe half, maybe 0.2. And what this means is that for every order has this, 50% of orders order this, 25% of orders order this. Or this is where the sum is greater than 1. I could also change it to say that maybe this is 0.5 and 0.25, 0.25, and it's like on an average order basis. What's the range of SKUs? And what I want to do is just do a simple sum product or an average, a weighted average. So I'm going to do some product of this and this. Since this adds up to 1, 20. And then now that I've calculated I've laid out all my SKUs and calculated a weighted average order value, all I have to do is take this and plug it in what I calculated there. Now this doesn't calculate out a revenue per SKU basis, it calculates out overall revenues. Also easy to change, right? So the corollary to this is, what if you want to do other products or other revenue streams, whatever. As long as you want to base them off of customers or customers during a period, very easy to do. So if I want to do, I could also add on SKU 2 here, for example. Or let's just call it SKU 4 and SKU 5. The drivers have a pre-built way to do this. So if I was to say that my SKU 4 was $25 per customer, and maybe SKU 5 was $50 per customer, I'm assuming that every customer buys these SKUs. Or I could assume that maybe the SKU price for SKU 5 is $50, but only 10% people buy it. Maybe I start offering it in month 1. Maybe I don't start offering this until month 12, and it repeats every month. So then I can say that I can use the driver of customers. So the customers during a period, and total customers, and then based upon number per. So this will do $25 times the number of customers. So the pre-built revenue model and the assumptions around there to calculate the number of customers. This will automatically calculate SKUs, the sales per SKU based upon that number of customers directly in here. And then to make sure it flows through the rest of the model, all I have to do is assign it as revenues. And that'll handle revenues in cash. So you might ask about inventory costs. So inventory costs is a core component of the model that's built into the forecast sheet, and the assumptions for it on Get Started. So the assumptions here cover here. And there's a couple of different ways to do this. What the model does is it's going to take your forecast of cost of sales, which we'll cover in a second, and then based on your schedule of cost of sales, it will then purchase inventory against that. And the reason why it's very different is going to make sure we account for the cash associated with this. The basic stock default side of the model just says, hey, if there's COGS, I can purchase the inventory during the current period, so there's no differences in timing I have to account for. But if you do have like a lead time, for example, say you have a 3-month lead time, you can assume a time lead time. If you want to have like a safety stock, you could say, well, I don't want to bring my inventory down to 0 at any time. I want to always keep it as a minimum percentage of cost of sales. It's also idea like a minimum order quantity. So, if you have a small amount of COGS, you may not be able to actually make an order that's small of a volume, right? So if you're $100 each, maybe you have $100 of COGS every month, but you can't purchase $100 of inventory. Your minimum order purchase may be $1,000. What it'll do is it'll figure out when you buy inventory, and when it buys inventory, it'll purchase at the minimum order quantity and do the inventory calculations off of that. The other two assumptions here cover when you actually pay for the inventory purchases. By default, it says, hey, I placed an order for inventory, I pay all of it when I place the order. But you don't have to assume that. You can assume that you set a percentage of the inventory order when you pay a certain percentage of it when you actually make the order, and then the rest of it gets paid some number of days kind of afterwards. Where that shows up is on the forecast sheet. That's directly in the inventory calculations here at the bottom. And what it does is it goes through the calculation inventory, says inventory you have, the inventory value at the beginning of period, new purchases that you're making, minus cost of goods sold and optional inventory disposals, and then figures out the value of the finished inventory and the changes in the inventory purchases over time. So the corollary to that is, how do I do cost of sales? So usually we're just going to put cost of sales as an expense item. So I'm going to include an idea like cost of sales, and I'm going to assign it to a cost category, which I'm probably going to call cost of sales. Now I'm going to assign it to product materials cost, and the reason why I'm going to do that is there's a number of items in here, and each one of these cost categories can be assigned to either SG&A, revenues or SG&A, and cost of goods sold. Most importantly is for each of the cost of goods sold items, I have a choice of whether I want to use it to apply towards inventory purchases. So by default, the model is not going to do that, but if I turn this on, what that means is the model is telling you that any of the cost of sales associated with that, I need to do inventory counting. The reason why this is different is I probably have some cost of sales which relate to like shipping, and I have some cost of sales related to the product. And so I want to separate those costs of sales because I obviously only want the product associated costs to factor into my inventory calculations. So then on here on cost of sales, I'm going to say, well, maybe if my average order value is $20, maybe my average cost of sales is $10. So again, same way I did the revenue calcs for these SKUs, I'm going to do dollar per number of customers. So this will automatically calculate the cost of sales as a function of the number of customers per period. And if I also want to do like a shipping, like I also added shipping costs, and maybe that's $9. Maybe I also wanted to do shipping revenue, for example. Maybe shipping revenue is $6 or $7 or whatever. I can assume these same assumptions here and calculate on a quarter basis. This is all done obviously this is all done on like a total customer basis, but you could split this into any level of detail you need for different components of your product mix. In the same way I did this revenues per order, I laid out a number of SKUs and revenues per order. I can do the exact same thing for costs. So if this is my revenues, I could say that maybe this is 8, maybe this is 5, maybe this is 18. But I could do the exact same incidence calculations and the exact same thing, and then feed this 9.75, feed it into this calculation here for product costs. So there's a flexibility of creating averages and weighted average revenue as well as cost of sales and then feeding them through. And I can also choose to individually lay out each component of cost directly in the core forecast. Kind of depends upon personal preference. Now, because I can filter all the costs, all the revenues and costs, I have a lot of flexibility to do, different kind of revenue mixes. If I have an e-commerce business that has a subscription component, pre-built into the models is I can replicate the core revenue build multiple times. I can add on a completely separate schedule for it. I can use either e-commerce or the SaaS forecasting tools as separate revenue components and feed them into the forecast sheet here. I could add on a wholesale forecast or retail or whatever that may be. All I have to do is put in the line item here, either use the drivers here to generate it, or just directly link it into here from another forecast they created, or just manually type in a forecast directly into here. So there's a lot of flexibility to layer in a number of different revenue streams towards that. If you have any questions about this stuff, happy to help anytime.